give us his perspective on the future of our currency, please join me in welcoming our guest today, Barry Eichengreen. Thank you.
Thank you, Joanne. You not only laid the foundation for the talk, but you summarized the book better than I probably can. And thank you to the Carnegie Council. Books at breakfast is a very nice idea, although 5:15 a.m. California time is a bit ambitious for some of us. My book is an attempt to use the economic history to use the dollar's past to try to draw some insights about the dollar's future. Books go off to the publisher, how should I put it politely, somewhat in advance of their appearance. And when you write a book that reflects on possible futures, the possible future of financial markets, you wonder what the state of the world will be at the point in time when the book appears. It was formally published last Friday, and thankfully the dollar is still in the news. Not all that news is good. There has been, since the book went off to the publisher, the Fed's decision to engage in a second round of quantitative easing, and complaints mainly on the part of policymakers in emerging markets that this was an overt attempt to debase or devalue the greenback. There is still the specter of trillion-dollar budget deficits extending into the future as far as the eye can see. There is the soaring price of gold, which, among other things, reflects less than full confidence in the prospects for the dollar. But there is good news as well, namely that other currencies have even more severe problems. The euro at the moment and the dollar has the exorbitant privilege, the phrase coined by Charles de Gaulle's then finance minister, Valéry Giscard d'Estaing, that it's not only America's currency, but the world's. And it's the world's currency to a quite remarkable extent. The dollar, we learned last week from the Bank for International Settlements, which conducts a survey of foreign exchange trading every 3 years. The dollar is involved in, currently used in 85% of foreign exchange transactions worldwide. It still accounts for 61% of the foreign currency reserves of central banks and governments worldwide. Countries like South Korea and Thailand set the prices of 80% of their exports in dollars, despite the fact that only 20% of the goods they ship abroad actually go to the United States. When Somali pirates ransom a ship, hijack a ship, they demand that the ransom money be parachuted to them in dollars. When Mr. Karzai's people get bags full of money, the money in question, of course, is in dollars. This is not, this fact that the dollar is the world's currency is a considerable convenience to Americans. We can pay our taxi drivers in dollar bills in many cities around the world. It makes doing international business easier for American corporations, but it's not entirely an unmixed blessing. Since foreigners want dollars to finance their international transactions, they want dollars to hold as insurance against the possibility that something might go wrong in financial markets. They're willing to lend to us at low interest rates in order to acquire those dollars. So if we in the United States are prone to excesses, for example, if we engage in frenzied real estate speculation, foreigners willingly give us more rope by purchasing not only U.S. Treasury securities, but the securities of Freddie Mac and Fannie Mae. Now, of course, after the financial crisis, we have learned the error of our ways. American households are spending less and saving more. That is a fact. The household savings rate has risen to 6 or 7% of household income. The fact that American households are spending less means that we have to export more of what we produce. And part of doing that will involve making our goods more competitive, making them more attractive to foreign purchasers. We need a somewhat weaker dollar as part of this adjustment, but find it difficult to impossible to obtain that weaker dollar because given the dollar's singular role in the global system, other countries are accustomed to pegging their own currencies to the dollar. And that frustrates America's effort to engineer a somewhat weaker dollar and get on with this adjustment. So you'll be aware that this is a flashpoint in relations between the U.S. and China, and it will come up next week when the Chinese president visits Mr. Obama. But the point is more general. How did we get into this situation? The dollar achieved its position of dominance after World War II, when the U.S. economy, the United States was the only economy standing. The United States was the dominant industrial power. We were the world's largest exporter. We were the only country with deep and liquid financial markets open to foreign governments, foreign central banks, private investors of other countries. So it made perfect sense for people who wanted to hold foreign financial assets to hold dollars, and for other transactions in international markets to go through the U.S. dollar. There was no intrinsic reason why Europe, Japan, and emerging markets should remain so far behind the United States. And as you know, the subsequent half-century saw a process of convergence or catch-up where other parts of the world have begun to close the gap vis-a-vis economic gap vis-a-vis the U.S. So we now live in a more multipolar economic world, but we still have a dollar-dominated international monetary and financial system. So if you want a very encapsulated description of how I understand the recent financial crisis we've been through and the continuing financial volatility we experience, is that there is this imbalance or this tension between what is now a multipolar global economy, but still a disproportionately dollar-dominated global monetary and financial system. So why is the monetary and financial system so dollar-dominated? The traditional answer is the advantages of incumbency. The dollar is the incumbent global currency. Incumbency is an advantage for politicians seeking to hold on to office. It's an advantage for currencies seeking to hold on to their international status. The argument goes that if everybody else is using dollars for their international transactions at a point in time, it will be convenient for them and therefore convenient for you to do the same thing. If you're a company exporting a particular commodity and your competitors price their goods in dollars, it will probably pay for you to do the same thing, to make it easy for your customers to compare prices. That's what your customer base will be used to. So economists have a name for this situation. They call it a market characterized by network externalities, where it pays to do the same thing everybody else in your network does. So that's the story why the dollar is still the world's currency. And it has an implication that the dollar will remain the world's currency because of the advantages of incumbency. So I want to suggest that this is wrong. It may have been a convincing story once upon a time, but it's convincing no longer. It may have been true once upon a time that only sophisticated traders and investors could compare the prices of different goods or different financial assets denominated in different currencies. But now everybody carries in his pocket or her pocket a device called a smartphone. Now Currency Converter is one of the top 10 downloaded apps at the Apple iStore. So I think that we can all looking around the room, everybody in the room can remember the day when you bought your first personal computer and you didn't have a choice of operating systems. You had to use the one everybody else used unless you were a computer hobbyist. If you had an interest in exchanging data with coworkers, you had to use Microsoft's product. But now there's a proliferation of operating systems. Switching is easier. And I think what is true of computer operating systems is increasingly true of international finance. I think we're moving to a world of multiple international and reserve currencies and away from the world in which there was only the dollar. I think we can get there in as soon as 10 years. And I think if we succeed in navigating that transition, the world will be a safer financial place. There will be a better balance between the multipolar real economy and what will then be a multipolar monetary and financial system. And because there will exist alternatives, the discipline on market discipline felt by countries like the United States that issue one of these reserve currencies will be stronger. If we do things that alarm international investors, they will have alternatives. And that kind of market discipline, I think, we have learned from recent experience can come in handy. So you will be asking at this point, what currencies specifically am I talking about? If you ask me, what will the important international currencies be 10 years from now, I would answer the dollar, the euro, and the Chinese renminbi. So I'm sure people around the room will pause at this point and say, one of those currencies is clearly not ready for prime time, and it won't be still 10 years from now. The problem being that people at different tables will object to different ones of my three candidates. So let me say a few words about each of them. You will know that pessimism is greatest at the moment about the euro. It's not clear that the crisis countries in the euro area being forced now to impose draconian budget cuts can recover without reintroducing their own currencies, or so it is argued. Keeping them in the euro area would require massive fiscal transfers to the crisis countries from Germany, and German voters would rather abandon the euro and reintroduce the Deutschmark than go for that, or so it is argued. You will anticipate, given what I've already said, that I think this euro doom and gloom is overdone. Some historical processes are very hard to reverse, and I think the movement to create a currency union is one of them. I'm not ruling out that there could be more serious financial problems in the euro area, and I personally attach quite a high likelihood to the possibility that Greece or Ireland or another euro area country will have to restructure its government debt, engage in what people offhandedly refer to as a debt default. But just like a default by Nassau County would not mean the end of the dollar, a Greek default would not mean the end of the euro. And I would argue quite strongly, I'll leave it for the Q&A, that for a country like Greece, to at the same time reintroduce its own currency would only be making its problems worse, doing even more damage to its banking system and to investor confidence. Germany is the one country that could, in principle, abandon the euro without precipitating a very grave financial crisis. But I think there are compelling political reasons and compelling economic reasons why it would never do that. Germany has too much invested in the European project. I personally think this talk about a new generation of German leaders having a very different attitude to that about the European project is overdone. And Germany's economic success in the last 10 years can be summarized in one word: export. And that would be very, very difficult with a Deutschmark that would go through the roof against the rump euro. The German business community is still very strong pro-euro because they understand on which side their bread is buttered. So Europe, I think the euro is here to stay. It is clear that Europe has a lot of work to do to complete its monetary union, to put the crisis behind it. I can talk about the specifics later if you want, but the crisis has now come to the point where everybody, European policymakers, now understand exactly what needs to be done, and now they have to forge the political consensus to do it, I think, between now and their summit at the beginning of February. Jean Monnet, the father of European integration, said that Europe is forged in crises. More recently, Jacques Delors, the father of the single market, said Europe has to rediscover its soul. I think the crisis will make Europe realize that it has to go forward or it will go back, and as it has at each similar juncture before, it will go forward. And one of the things it will have to do is issue limited amounts of e-bonds, bonds backed by the full faith and credit of the entire collection of euro area countries. And that will be a first step toward creating the deep and liquid treasury bond market in Europe that will ultimately be similar to the deep and liquid treasury bond market that we have in the United States. So that's the euro. Let me say a few words about the dollar, which may be what brought you out this morning. The challenges facing the dollar, as Joanne said, I think are fundamentally fiscal. What alarms international investors is the prospect that we will let our sovereign debt, our government debt, run out of control. And when they look deeper, they are worried, just like many Americans are worried, about political polarization, dysfunctional politics, and the inability of the parties to work together to bring this problem under control. Our federal government debt is approaching 75% of national income. For a federal government that only raises 19% of national income in taxes, in a good year, the tax take goes down. In recessions, servicing the kind of debt load that we already have is a formidable task, or at least it will be when interest rates go back up to normal levels, as they eventually will. So I think that solving this problem will require the parties to acknowledge that there is no single solution to the budget deficit problem. It can't be fixed simply by cutting spending. There will have to be what we might euphemistically call revenue enhancement. There will have to be more taxes of one sort or another, and there will have to be completion of the process of bending the healthcare cost curve, because it's healthcare expenses that will make the budget deficit really explode going forward. If foreigners don't see progress along these lines, they will conclude that the U.S. will end up having to resort to expedients. We will inflate away the real value of the debt. We will withhold payment of interest on government bonds, or resort to some similar expedient rather than cutting essential public services. Foreigners can solve this problem forward, and they would try to get out of the way before the worst occurred. So that's the scenario in which there could be a dollar collapse, a dollar crash, a dollar crisis, which would mean mass flight by international investors, public and private, away from the greenback, which would be costly to, obviously, to the United States. So that's not my baseline scenario. The United States has faced and dealt with formidable challenges before, but this is something to worry about, a scenario that serious people ought to ponder. In the book, I wrote something to the effect that the United States has maybe 5 years to get its fiscal and financial house in order, and I must admit that I've grown more pessimistic since then. Economic history tells us that financial crises occur around the time of elections. Lehman Brothers occurred right before a presidential election when it wasn't entirely clear who held the reins of policy and who could move, and uncertainty about what would be next was pervasive. So I don't know that I've grown so worried now that I think the end of 2012, beginning of 2013 is when it's possible the worst could occur. But again, I think serious people should think about this. Finally, there is the third of my three candidates, China's yuan or renminbi. China has a lot of work to do in order to complete the process of internationalizing its currency. China understands that, and it is working very hard. It is moving now very fast to complete that process. Chinese policymakers understand that it would work to the advantage of Chinese firms if they could do business in their own currency, and they didn't have to incur the expense of having to buy dollars when they wanted to export or import, that Chinese banks would benefit from having a slice of international financial business. And they could do that more easily if their own currency was freely traded. So you will have seen either yesterday or the day before that the Chinese authorized one of their big banks, the Bank of China, to begin to provide foreign exchange trading services to Americans, to open up renminbi-denominated bank accounts in New York. You may have noticed that a share of bank accounts in Hong Kong that are not in Hong Kong dollars but in Chinese renminbi quadrupled in the last year. China went in the last 12 months from a position where basically none of its companies did their import and export business in China's own currency to a point now where 70,000 Chinese companies are doing that. They're now something on the order of 50 dim sum bonds denominated in China's own currency, issued by companies like McDonald's and Caterpillar and a variety of others. So a lot of this business is still being done all of it basically is still being done in Hong Kong, right over the border from China. But Hong Kong is their petri dish for cultivating these practices and testing them out. I think what is happening in Hong Kong now will be done in Shanghai 5 or 10 years ago. So the Chinese have to do lots of things. They have to strengthen their financial system, strengthen confidence in their financial system, strengthen rule of law. If they open their markets to financial inflows and outflows, they will need a more flexible exchange rate as a buffer or a cushion against capital flow volatility. But I think they're serious about doing that. They've set a deadline of 2020 as the date by which they will have transformed Shanghai into a true international financial center. And if and a corollary of that would be greater international use of China's currency. History also suggests to me that this kind of rapid transition is possible. The history of my own country suggests that it's possible. So the United States went from a position where the dollar was not used in international transactions at all in 1914, actually to a point where the dollar had overtaken the pound sterling as the leading currency for trade invoicing, for the issuance of international bonds, and as a form of central bank reserves already in 1924. Now, I will acknowledge that other things intervened between 1914 and 1924 to weaken the position of the dominant international currency, the pound sterling. But we in the United States, people like Senator Nelson Aldrich from Rhode Island and Paul Warburg, the New York banker, were expressly interested in enhancing the international use of the dollar in order to advantage American corporations and American banks. That was one of their motivations for supporting the establishment of a central bank. The Fed was founded in 1914. The Fed then set out to create a market in trade credits and other foreign investments in dollars, and it had succeeded in 10 short years. So I wouldn't disregard the possibility. I wouldn't dismiss the possibility that the Chinese, who are intent on achieving the same by 2020, will succeed. So the dollar, the euro, the renminbi all face challenges either to hold on to or to acquire international currency status. But I think the fact that that there are questions about all three suggests that none of them will necessarily be dominant, and that there is room on the international stage for all three of them. What will this mean for Americans, and what will it mean for the international system? I do some calculations in the book about what the implications for American living standards and American incomes would be if the dollar lost its exorbitant privilege entirely. And the kind of numbers I come up with are that would cost us $225 billion, 3% of U.S. GNP. That's 1 year of normal economic growth. So it's not a catastrophe, but one would feel it. We would feel it in the form of higher borrowing costs, higher funding costs for the government, because foreigners would no longer be absorbing the majority of the treasury bills and bonds that we issued. If the government had to compete at higher interest rates for funding, others, corporations and home buyers would face higher interest rates. The dollar would be somewhat weaker. You would see higher prices for flat screen televisions at Best Buy. So again, it's not a disaster from the point of U.S. living standards, but 3% of U.S. GNP is 1 year of economic growth. And we've had a recent reminder of how much better people feel when the economy is growing than when it isn't. That kind of change would be felt. On the other hand, I do think that moving toward a system where there are multiple international currencies would help us in terms of dealing with some of the sources of financial volatility that we've seen recently. As I explained, there would be more discipline felt by the reserve currency issuing countries. Other people object that the kind of system I've described could be dangerously unstable, that with the dollar and the euro and the renminbi all being important reserve currencies, central banks and governments, if they perceived the existence of problems with one of those countries, could easily switch into the others. The problem currency would collapse, the others would go through the roof, exchange rates would become dangerously volatile. I don't believe it. I think central bank reserve managers don't act the same way as hedge fund managers. They're not compensated. They don't have the same high-powered incentives. They're not compensated on a 2+20 basis. They don't have to exceed the previous high watermark in order to draw a paycheck. They have social responsibilities, and they know it. I have, by this point, talked to a lot of them. They have patient. They're investors. Their principals are more patient than those of hedge fund managers. Central bank reserve managers have guaranteed funding. They find it easier to act as contrarians when everybody else is panicking and selling a currency. They can step in and buy it and stabilize the otherwise unstable exchange rates. And that seems to be what the data show. If you want a recent example, in the third quarter of last year, the dollar was relatively weak, and central banks around the world bought more than $100 billion worth of dollar bonds. that same quarter, acting in effect as stabilizing speculators and rebalancing their portfolios. So I am ending, if you will, on a high note. I'm not entirely a messenger of doom and gloom. If you buy my argument, then you should see our current difficulties as a reflection of the imbalance, the existing imbalance between our increasingly multipolar international economy and our still dollar-dominated international monetary and financial system. So the good news is that this is a problem that should solve itself over a period of, say, 10 years, if we can safely get from here to there. The bad news, of course, being that history teaches us that financial crises of one sort or another occur about every 3 years.